Marc Faber, author of the Gloom, Boom and Doom report. Marc, an absolute delight and a pleasure to have you back on ET Now. Now, Marc, it's been a roller coaster ride for equities so far in 2014. US markets are at a record high. Indian markets are giving them company, but rest of emerging markets are really under pressure. What explains the surge in recent and select emerging markets, and are we ripe for a significant correction?
Well, we have different economic developments and also political developments around the world. So some countries have continued to slow down in terms of economic growth, and their current account deficits are not improving. So these markets have been rather weak, whereas in the case of India, the market has been strong, because we are moving into an election, and there is hope that the BJP and Modi will win this election and be able to form a workable government. And in the case of the US, money is flowing into the US because it's perceived to be the only game in town, so the market has continued to go up.
Marc, so where do you see the US dollar headed from the current level? Certain emerging market currencies like the lira, peso, as well as the rand have been under severe stress recently. What's your outlook?
Well, my sense is that the US dollar should rally also against the euro. But it hasn't happened so far, which is very surprising because you look at the energy situation in the US, it's improving. Some people are talking about the US becoming energy self-sufficient. It's not necessarily my view. But although you have these positive factors that should support the dollar has continued to be weak against the euro. I admit that it's been strong against other currencies, such as emerging market currencies in general. But as I said, I'm surprised that actually the dollar is not stronger given what some investors perceive to be very positive factors.
Marc, we've seen the US Fed undertake a mild taper to reduce monthly bond purchase program to about $65 billion. But you've not held the view that QE taper is likely to come to some kind of an rest. Do you have any expectations from the FOMC meeting later this week?
Well, basically, what they usually say is that everything is data dependent. In other words, let's put it this way. Since October 2011, we haven't had a significant correction in the market. The largest corrections were corrections of less than 11%. And actually over the last 3-4 months, we've gone up very strongly. Now, if the data deteriorates and if the stock market would decline by 20% over a given period of time, I think they would actually increase the asset purchases and actually give up the tapering that they propose.
Let me just mark the benchmark indices, and what a turnaround. It's a complete reversal of fortunes, 20 points up for the Nifty. The Bank Nifty, which was, it appeared 10 minutes ago that the Bank Nifty was looking slightly weak and fragile, but the Bank Nifty from the day's low has managed to bounce back, and has managed to bounce back how? It's a recovery of more than 100 points on the Bank Nifty. Now, what is making all the difference in the Bank Nifty? ICICI Bank, IndusInd Bank, PSU banks, which are looking slightly weak, they've also managed to bounce back. So, you know, the market trend is just telling you that the underlying momentum is very strong, and dip buys clearly are dominating and dictating Indian markets. But the big factor is still China. And Mark, the Chinese government is looking to focus on quality of growth by slowing development indicators in China. Do you worry about what is happening in China? Because China is one of the largest trading partners for many countries.
Well, I have pointed out to a meaningful slowdown in the Chinese economy for now more than a year. Now, the government was very good at massaging the economic data and hiding the slowdown, but it's now becoming clearer and clearer that the slowdown is on the way. And I suppose that China has been and will grow at maximum like 4% per annum, which is a relatively slow growth rate. But it is a very high growth rate compared to, say, the United States or European countries. So it's not all that bad.
Marc, so talking about commodities, what is your sense in gold prices? We saw some interest as tensions perked up between Russia as well as Ukraine. The physical demand in China and India remains strong, though the government did place import curbs. Is it time for gold to shine again? Do you think it will be a long haul?
Well, if I look at all asset classes, real estate, equities, bonds, commodities, and art, I think that gold is relatively inexpensive at the present time because we had a meaningful correction. Don't forget we went to $1,921 in September 2011, and since then we've been in a declining trend basically until recently. And the BIS has just published the size of the global bond market. When I started to work on Wall Street, the global bond market was $790 billion. And before the crisis in 2007, the global bond market had already increased to $70 trillion. And now the global bond market is at $100 trillion. Something doesn't add up in the long run, and something will break one day. We'll have another crisis. And under these conditions, I would own some gold.
Marc, what about agri-commodities, soft commodities, which are also attracting a lot of attention? The drought in Brazil has led to a surge in coffee prices. Even sugar has managed to bounce off from the multi-year low. How are you looking at agri-commodities as a group, as a basket?
Yes, that's a good point. We have, because of more volatility in weather patterns, we have droughts and floods and natural disasters, and they can have a meaningful impact on the pricing of agricultural commodities. Now, the difficulty in playing the agricultural commodities is that you got to get the timing right. So if you bought coffee in December of last year, by now you're up close to 70%. But not everybody was able to buy coffee at the end of December last year. I'm just saying, for the individual investor, there's huge volatility in commodities, but the timing has to be proper. The second way to play the agricultural commodities is to buy essentially agricultural land or companies that are farming or that have plantations or that are food processors. And so in Malaysia we have numerous plantation companies which I regard to be reasonably attractive.
Marc, so how would you play the Indian markets ahead of the elections, and what strategy would you advise investors for the run-up up until May?
As you know, we have a lot of indexing around the world and a lot of ETFs that just buy the index. So one way to play it, I guess, is just to buy the index. But like in other markets, we have in India stocks that are very expensive, mostly consumer stocks and large market cap stocks. And then we have many companies that are basically selling for very low valuation, low PEs, low price to sales and so forth. I think the banks are probably quite attractive here.
Mark, you've been quoted in the past saying that some Indian stocks are looking attractive. So what do you like within the Indian markets? What sectors or stocks are on your radar, and where do you see value in Indian markets?
As I said, I don't run an Indian portfolio. I'm the chairman of an India fund, but we have a manager who runs the fund and he does the stock selection. But from what I understand at presentations he makes, the banks are relatively inexpensive at the present time in India.
Mark, on the macro front, the news from Indian economy hasn't been all rosy, barring the slight dip we are beginning to see in inflation and the recent quarterly current account deficit data as well. Do the economic fundamentals of India worry you right now?
No, I think that there has been some adjustment. Economic growth rates have come down significantly, but the fate of the Indian market will depend A, on global markets, and B, on the election and what kind of government India will get. I think there is a lot of potential for government reforms that would include reducing the size of the government and the influence of the government in economic activity. In other words, we would have to have kind of a market-friendly reforms that would then be favorable for economic growth. Less government, more growth.